Hello, welcome to LW Fund High Yield Strategy video presentation. My name is Ken Wang. I am one of the investment managers here at LW Fund. With me is Mr. Warren Kwan, the Chief Investment Officer of LW Fund.
Hi.
Today, we would like to take the opportunity to go through some simple examples to demonstrate how the LW Fund high yield strategy generates yield, and how we keep our risks limited while achieving a higher than average yield. To start with, our fund objective. Our fund aims to generate a high stable yield with a target return of 10% per annum. Our main risk management factor is that we want to keep our Sharpe ratio as 2 times or better. Generally speaking, our fund strategy can be described as a managed structured products fund, where we utilize structured products to capture enhanced volatility and correlation premiums. In other words, we earn high yield through market fluctuations. Okay, how do we capture volatility value? First, let's go through some simple examples. The most direct way to capture volatility value is to sell an option. Investors in this area generally combine aspects of fundamental investing with volatility capturing. The most common method is to hold a portfolio of high-quality stocks and sell call options on these stocks. Okay. This method is usually called the covered call writing method. This method has been around in practice for a very long time. It's one of the first option strategies adopted by mutual funds, and many investment funds today utilize this methodology to enhance earnings. Another way to achieve a very similar risk profile is to, on a similar dedicated high-quality stocks, sell downside put options on these stocks. This method is often more preferred by sophisticated individual investors. Both these methods work in very similar ways. The investments make a profit through capturing volatility value. They also have similar shortcomings in the way that if the selected underlying stocks perform poorly, both methods are open to losses. LW Fund, we improve on this basic strategy, and we will, through the next few examples, demonstrate how we do that. First, let's start with a very simple example. Assume our investor, or ourselves, is very confident in the value of Apple Inc. To express this confidence, the investor, or the fund, sells Apple put options with an 80% strike, and with a maturity, let's assume 1 year. And at the moment, this option is worth about 3.5%. Assume a year goes by, and Apple does not decline more than 20% over the period, and the investor, in this case, successfully earns the option premium. Okay, to quickly analyze and discuss on this simple example, Warren, can you quickly go over the advantages and disadvantages of this general method?
Okay, I think if you look at the simple put example, the good thing about it is the investor don't need to think about too many things, and no matter what the stock would do, he or she will earn a premium, no matter what the stock would do. Unfortunately, that's exactly the problem. Is if the protection is not engineered enough protection, then the investor will expose to the downside volatility of the stock. So I think the key is to how to engineer enough protection at the same time have enough yield for the investor. If you engineer a big enough protection, say 1 standard deviation or 2 standard deviation, usually that means around 20% away from current price, and usually the yield is extremely low. And investors are usually very aware of the yield, the low yield environment, and so by chasing yield, usually they give up some kind of protection on downside. So it may be even I've seen investors doing 95% put, or at most people would give up 10% downside protection in order to get high yield. And I think in this environment, that is not enough. So we'll show how to have the kind of protection you need, but at the same time have the yield good enough for the investor.
Basically, to quickly summarize, utilizing the simple sell-put volatility capturing methodology, the investor's fundamental decision does not have to be as high quality. In other words, the investor does not have to count on the stock going up to make money. In this general strategy, the investor will capture volatility value or earn a profit on the investment as long as the stock does not drop below strike. So investors can increase the probability of making a profit by picking a safe strike. In other words, as Warren Buffett mentioned before, a larger discount to current spot. However, when you increase the protection to cover a very large range of stock prices, then the return on this investment becomes very low, and the investment is still open to potential large downside movements. So how does LW fund improve on this general simple methodology? To start with, we need to add another factor. Another factor in this case means another stock. Assume that in our example, the investor has a similar high conviction in another stock, Intel Corp in this case. So 1 year 80% put, similar to the previous Apple example, is also trading at about 3.5%. That's a coincidence. The investors can choose to sell puts on both stocks in a 50-50 split and earn a average yield of 3.5%. Or the investors can choose to sell a structured put. In this case, in our example, the put is a worst of two performance stock, and the same strike of 80%, the same period, 1 year. This worst of two put for Apple and Intel is currently worth about 6%, slightly over 6%. Or in other words, roughly double the premium received in the previous example where we sell an option on a single underlying.
Maybe Ken, I think you should go through what the worst of put really means.
Okay, the worst of two put, as opposed to a simple vanilla put, the final put value is determined on whichever stock performs worse. For an example, like say after a year goes by, Apple drops 23% to finish at 77%. And Intel drops only 10% to finish at 90%. Our put strike is 80%. In this case, the put final payout will be determined on the lower performing the two. In our example, Apple went down to 77%, so the put is in the end worth 3% because Apple went below strike and Intel did not. However, if both stocks finish above strike, then the option is still worthless. If both stocks finish below strike, let's say Apple finished at 70 and Intel finished at 75, then this put will pay out 10% on the lower of the two. To go through a basic risk and return analysis, what we're looking at here is a screen cutout from a Bloomberg simulation. In this simulation, we are starting with assumed starting investment of about $100, where we would sell an 80% strike out 1 year and receive about three in this case. As of 8th of June, the fair market value is roughly 3.85% for this put. So the starting value of our investment is very close to 100. Let's see how this investment does in a historical simulation. In our simulation, we are using 3 years worth of data, starting in June of 2014, going to today, June 2017. On the bottom right hand of the screen, we can see that the average or mean return of our strategy, mean total return is 103.333. Basically means our investment on average would earn about 3.3% with a standard deviation of 1.67 or 1.68%. The minimum or the worst performing over the last 3 years, the investment returned $93.78, a loss of slightly over 6%. And the best case is basically the put total values earned is about 3.87. This is the same view turned over to in an internal rate of return. Other words, converting all the returns into an annual yield. So in the same simulation, the average return is 3.2% with a standard deviation of 1.6%, minimum down 6%, maximum is full option premium 3.7, 3.8. Now let's look at how this strategy does with the addition of the second stock. Now this simulation, we're starting with worst of two stocks, Apple and Intel, using the same starting day, June 8th. And we priced that the fair value for this option at current market is about 6.3%. So starting similarly, starting with $100, sell this option and receive 6.35. So the initial option, value of our investment is still about 100.
So Ken, maybe we slow down a little bit. So what you are saying is by adding one stock, instead of 3.8% coupon, now we got 6.35%.
Yes, this option, because we introduced the second factor, and now the potential return for the buyer of this put is now higher. So statistically speaking, this option is worth significantly more than the previous example. In this case, the fair market value with the current to market conditions is 6.35%. So the seller of this option takes in 6.35% to start.
Okay, so the strike is the same.
The strike is the same. Strike is still 80.
Okay.
So now let's look at, in the same historical simulation, how this investment would do. Also going with 3 years of the data on the same dates. Now the mean or the total return for our investment after a year holding this position for the last 3 years, the average return is 5.85%. Standard deviation very similar to the previous case, still 1.67. The minimum, the worst case for this investment is actually better than the previous case. Now the worst case is 96.3, whereas the previous case is about 94. And the maximum is basically the full return of the put premium, 6.35% ish. And converting over to an internal rate of return view, the mean return is 5.6% per year, standard deviation 1.6%, worst case negative 3.5%, and maximum is positive 6.1% annual yield. And the reason why the minimum is higher than the previous case is because in the second example, the investor received a larger premium upfront.
So what you're saying is by adding another factor, what it does is actually not worse off, but is better off.
Yes, the investor in this case, because the investor's fundamental view on the two stocks is correct. So not only did the risk of this investment did not increase, the risk of this investment actually decreased in this case. Okay, to summarize, what is the effect of adding a second stock? Assuming the investor's fundamental views were reasonably correct, basically means that neither picks are horrible. Then, in majority of cases, the investor earns a greatly enhanced return. In our example, about doubling the premium received. In the worst case, assume that an investor puts on this trade and the general market collapses and both stocks fall far below strike. The likely loss of capital for the worst of two options is not significantly higher than selling put options on the same two stocks in a combination, because both stocks would have fallen significantly below strike in a general market collapse. So in other words, in the worst case, the worst of two options also does not significantly underperform a single put option. But overall, the investor in the worst of two options receives a much larger premium, and in our example, this investor is earning additional return through the capturing of correlation value. Correlation value is basically the value derived from the relative movement of the stocks. We can actually take additional steps to further enhance return for our structures. In our example so far, the worst of two put premium is collected in one payment without conditions. We can enhance the total payoff or the potential payoff of our structure by adding terms and conditions to the premium. Changing the lump sum payment into a daily range accrual in a yield where we collect a certain amount of coupon every day, as long as the underlying stock stays above strike.
Maybe we should step back a little bit because the audience may get confused here. Okay, so what you're saying is we are doing some kind of financial engineering technique in this case?
Yes, absolutely. We are utilizing financial engineering technology and adding some structuring techniques. We're changing the structure of the payoff. Whereas we receive the put premium in one payment, now we receive in a daily string of premiums. And now this premium comes with a condition where the premium is only paid if the underlying stocks stay above a certain level. In this case, we choose the strike.
Okay.
And also we can add an early termination condition to this string of payments. In other words, if the underlying stocks in our structure both start trading above a certain trigger level, this string of payment would end and the entire structure would terminate. By adding these two conditions, the probability of receiving the payment is now no longer perfect. Therefore, the actual nominal yield of the payoff can go higher. By adding these conditions, we're actually describing a typical trade, typical structure in LW fund. The yield generated in this methodology is typically range around 11 to 15% based on similar underlyings. Okay, now let's look at how the finished product performs in a similar risk analysis. Now we're going with two stocks, Apple and Intel. Same strike, 80%. Now we have changed our coupon payment to a conditional coupon where the coupons only received if both stocks stay above 80%, and the string of payments would end if both stocks go above 103%. In this structure, the fair market payoff would be 13%, because now the probability of paying the coupon is no longer perfect, as in the case of receiving 6.3% in a lump sum. So now we're pricing this initial value of this investment also at a very close to 100. Let's see how it does in the same simulation.
Maybe what we can summarize the structure is that from the investor angle, as long as both stocks are within the range, and in this case is between 80% and 103%, we will collect 13% annualized yield. daily.
On a daily basis.
So from the investor angle, it's very simple. Do you think the two stocks that you have chosen will be likely trading within this range? So it's actually a very simplistic structure, but we have to go through all this. Sounds very sophisticated explanation, but in fact the end result is quite elegant.
In this trade, if both stocks stay above strike and within the under the trigger, then we would collect a total of 13% for a year. How this trade would do in a simulation over the same period, roughly June or end of May 2014 to today, the mean total return with this methodology is 104.84%, or receiving about 4.8%. Standard deviation is 4.5%, with worst case 94 and maximum 112, close to 113. Because this structure can early terminate, so it really makes more sense to look at this simulation in internal rate of return, converting all the cases into annual yield, because most of the trades will early terminate. So in our simulation, the mean yield return is about 8.6%. Standard deviation is about 4.2%. Minimum -5, -6%. Maximum 13% up. So now we can see that in this example, the worst case is very similar to the previous examples, about -5, -6%. Well, the mean yield is significantly increased, now to, in this case, 8.6%, whereas the worst simple put is about 6%. To summarize the steps that we went through to improve the yield of the basic structure, we're starting with the building blocks of Apple and Intel 80% put. The starting value is about 3 to 4% range. We're taking these basic building blocks and converting them into a worst of two situation, where the return now is enhanced to around 6%. So by adding correlation premium, we improve the 3% case to a 6% case. By additionally, by engineering the payoff structure, we can further enhance a 6% yield to around 11 to 15% yield.
I think that also the key concept behind this engineering technique is we haven't seen the risk increase linearly with the yield, right?
That's correct. The yield and the actual risk are not going up in a one-to-one case, especially when the investor started with high-quality picks of underlines. So, what can we do once we earn higher yield? As we've shown, that the premium generated by applying our yield enhancement strategy is greatly above the initial starting vanilla options. We have 11 to 15% versus 3%. The higher yield provides a budget to buy equivalent vanilla options to protect against losses. In other words, we can put up our trade and earn a yield of between 11 to 15% and buy back in proportion or in whole the embedded vanilla option and spend somewhere between 3 to 4% and locking in a difference. So to summarize the effects of enhanced yield, applying our strategy, the first obviously is we're earning a higher investment yield. The second is that we can, because the structure has a higher potential payoff, we can increase the downside protection in our structure. To get a 10% yield through a pure simple vanilla option, the downside strike needed is probably somewhere between 90 to 95%. Whereas in our example, the strikes can be pushed down to 80% and we still get a portfolio yield around 10%. In some cases, we can push the strike down even further. And because we're earning higher yield, as explained in the previous slide, we have a budget to buy protection against losses.
Or I would say we can overlay it with other strategy.
Yes.
Even because we have predicted cash flow coming in. Yeah.
The key to long-term successful running of our portfolio is that now, using our method, we have to start with a high-quality portfolio of stocks. In other words, if we selected our stock poorly, then our performance will be poor, even though we have significant protection in the portfolio. The second factor to successful long-term management of our portfolio is diversification. By making picks every day and running a portfolio constantly, inevitably there will be situations where a pick will be not great. So it's important that we achieve a high degree of diversification so that the occasional poor pick does not damage the portfolio too much. And lastly, we need an effective hedging strategy. Where we said before, we have set aside budget based on our predicted cash flow to buy protection for the portfolio. So how you buy protection for the portfolio and not to waste this valuable budget is basically will make a huge difference on the finishing result of our performance. How have we done? Let's look at our performance running the strategy for the last 12 months. As of May 2017, LW Fund has returned 9.7% over the last 12 months. For 2017, year to date, we're now up 6.3%. Our performance volatility, our P&L volatility, is currently running at about 3.3%. Our achieved Sharpe ratio is about 2.66 times. And very importantly, over the last 12 months running our strategy, we have not suffered a single month of loss.
Yeah, I think I would like to sum it up on the following points. I think as a fund managers, we are very lucky to have this strategy because you know that all our investments are engineered with a very comfortable protection on the downside.
So, usually 1 standard deviation or more.
Yeah, right. So every night when we go home, we have a comfort on thinking, even if there's something happen overnight, we are well protected. And in additional to that, we have a luxury to buy protection on the downside without sacrificing our performance. So in combination of the two together, we are very lucky to have a very sustainable strategy. And also, I think one thing that we haven't mentioned very much is it's not very time sensitive on this strategy. So what's that really mean is we don't need to time the market to time the bottom, to time the top so much. And I think in the future presentations, we will show that factor and give you some examples when we actually invested in the peak of the market, and then we have examples that we have actually invested in the bottom of the market too. So, and show you the differences of the two. Actually,
it's not significant.
It's not significant. So, I think it's a very good strategy and very good comfort level for the investor.
Okay. To quickly summarize the advantages of utilizing LW high yield strategy, using our investment strategy, where our underlying portfolio contains only high quality, high liquidity stocks and indices. We are unlocking value not available through traditional investment methodologies. As Warren has mentioned a few times before, we do not need to pick winners to be effective. Our picks of our portfolio simply does not need to underperform the market by a significant amount. We are generating high yield with no exposure to credit risks or interest rate risks. Our method has a low dependence on any particular market parameter, so we don't need to time or pick a condition. Our portfolio duration is generally short. All of our structures are engineered to have a expiration of 1 year or less. We achieve stable high return with low volatility. The investment yield is scalable, and the risk is similarly scalable. So the investment style can be customized to fit the risk appetite of different customers. That concludes our quick presentation on LW high yield strategy. In our future presentations, we'll go through details of how we select our portfolio, how we engineer the structures, how we risk manage.
Thank you very much.
Bye-bye.